So Robert is the co-founder and or the founder and head of research at Liquity, and he will speak on governance, minimization, and immutability. Thank you.
Thank you, Damir, and it's a great pleasure to be here and talk about governance, minimization, and immutability. So I'm the founder of Liquity, which is an interest-free borrowing system which has been giving out loans against Ether as collateral now for a bit more than 2 years in a completely autonomous and immutable way. So I want to first talk a bit about the concept of immutability and minimal governance in general, and then give you a few hints how we have been implementing it, how we have been doing it at Liquity. So giving you like an overview how DeFi should be, or at least I think many people have their own views and understandings what DeFi should do. And I just like summarize it by those keywords: trustlessness, transparency, predictability, and permissionlessness. I think here it's really important that by kind of achieving those principles, everybody can use the system like in the same way, like it's a level playing field that also protects people from the greed and misbehavior of a few that may have control over them. So ideally, people who are using a DeFi protocol, they should be protected against that kind of surprises, against malicious behavior, or majority that goes rogue or whatever. So, I mean, that's kind of the ideal. But now, what happened in practice is that most often, or oftentimes, what we've seen is decentralization theater. But you can also like look at maybe from a different angle. Sometimes maybe that's a good thing. So I picked here 2 examples, which are not just black and white, but like a bit more in between, to showcase like what kind of interference or like human interaction there can be. Like both cases, one is Euler, which was hacked like I think 2 months ago. 200 millions were stolen, and then the interesting thing about it was that before the hack actually happened, there was a security firm, Forta, who has run some like monitoring, alerting systems that already detected the attack before it happened. And they warned Euler, the team, beforehand. And Euler apparently had, or it turned out they had a way to pause the contracts. They had a multi-sig, which gave them that right. And they ended up doing it, but they were too late. So by the time they kind of paused their contracts, it's a lending protocol, they paused the contracts, but the funds were already gone. Luckily, the funds were recovered later, which is a different story, but it just shows that sometimes having like multi-sig, like governance or whatever, like some form of admin control of the contracts could help to deter an attack, but in this case, it didn't really do anything. And people were upset in the end that like, why do they even have this control? The other case is also interesting. It concerns Oasis app, which is like an automation tooling system which manages other DeFi platforms like Maker, for example. And there was a big hack like a year ago where, again, like more than 200 millions were stolen from this wormhole bridge. And then the attacker kind of started using the funds that were stolen from this bridge then through Oasis. And it turned out that somebody, like some white hacker group, informed Oasis, like the team behind it, that, hey, you also have some vulnerability in your multi-sig in the way that you can control the funds. So you should take action and kind of steal back the funds from the hacker. And apparently, I'm not sure if it's true because I haven't seen it really in reality, but what they claim happened is that they were forced by a UK High Court to basically hack back, to steal back the money that were originally stolen, give it back to Jump Trading, which was the party that has suffered the loss. So you see here, having admin control can be a curse, can be, maybe it can help, but yeah, it's a difficult situation to be in. And it turns out that this is the overwhelmingly the case. Like for most systems, we see that almost 2/3 of like DeFi applications, according to this recent study, they are under the control of some multi-sig. And from the rest, I mean, even worse, like almost 20% are controlled by just one Ethereum address, and only very few, like fewer than 4%, are really immutable, like nobody can control and upgrade them. And it gets even worse because from those that are controlled by a multi-sig, most multi-sigs have like fewer than four signers, which is probably not the best security setup that you would want to have. So that's the situation we are in DeFi. And it is not just about contract immutability or governance. I mean, you have so many layers. You have the front ends that provide access to the tools, and they use, like RPC providers, they use MetaMask, they use Infura nodes to talk with let's say Ethereum nodes in the end. Like they can all be censored. I mean, this is all controlled by somebody. It's maybe running on Amazon WS or whatever. And then on the protocol layer, you have the actual contracts that may be controlled or somehow exploited. You have oracles as a dependency for most systems. On the asset layer, you have the actual tokens that you want to play around with or you want to move. Like it can be a stablecoin like USDC, which has a blacklisting functionality. So even on the token level or asset layer, there can be human interference. And then on the bottom, you have the infrastructure or settlement layer, the actual blockchain network, where it's not always so clear how decentralized they are. I mean, some networks aren't really decentralized. There can be censoring even on the ones that are decentralized, like Ethereum, like MEV and transaction censorship is a big issue. So what can we do to make this better? So one way is improving governance. I mean, by making better decisions, like kind of by broadening the governing body, by distributing the voting tokens, the governance tokens in a more equitable way. But that's not what I'm going to talk about. What I'm going to focus on is how can we just minimize governance or do away with it completely, like by just not having anything to change. So what that gives you is, with immutability, you have basically predictability, trustlessness, and transparency by design, at least if you properly document your code. And as a side benefit, you also get this kind of code security, which increases statistically over time. Because a system that always changes may always introduce new bugs and new kind of areas for breaking. But when you just put out code that is immutable and nobody has been able to hack it for 2-3 years, I mean, statistically, it should become safer. It's like not rocket science, but just an intuitive argument. And you can go even one step further by making the contracts not just not upgradable as code, but you can even completely get rid of all the parameters that may change. So there is really nothing then to alter. And then you really know what to expect as a user. There are no surprises, also no tyranny of the majority, which could happen when the majority wants to kind of squeeze out the minority for some reason, because it's in their best financial interest. It's immune to manipulation, bribery, extortion. There is nobody to bribe or really to extort. And here also, like a side benefit, now we have seen, especially in the US, that being a DAO member, being a voting member for governance body could lead to troubles, that could make you legally liable. But if there's nothing to govern, there is no liability. So, but there are also challenges, and then again, mitigations. So what happens if you really design a system to be completely rigid or completely immutable? It becomes rigid in a sense. Of course, you have to design your crypto economics at the beginning. You don't know whether they might become outdated later as the global environment changes, like as interest rate, for example, change. But you can mitigate this at least to some extent by modeling your system, by doing agent-based modeling, stress testing, by using timeless economics, for example, by not having an interest rate at all. And yeah, and also just the fact that your system is not alterable or immutable is an economic value in and by itself. So people may be willing to pay a higher price. They may be willing to pay a higher fee just for getting this extra predictability and security. Then, of course, this is an obvious one, bugs and hacks could happen. Now, what can you do if you cannot upgrade, you cannot patch your existing system? So here, I think it's key to just make sure that your code is as short and simple as possible. I mean, the Apollo mission from what I heard or read, was just a bit less than 150K lines of code. Now, our system is a bit less than 5K lines of code. And treat security as your top priority. Do testing, auditing, formal verification, whatever, but just do everything you can. And even if you have upgradeability, like most systems have, it's not a silver bullet, because the hacks can happen before and deplete your system. So even though you can patch it later, the damage might have already happened. What we can do, or like what an immutable protocol can do, is basically deploy a patched, like a second version in parallel. Like if there is this like emergency, like this worst case, you could deploy a new system and hope for people to migrate to the new system. As long as at least this migration is not affected by the bug, then people could kind of leave the old system and use the new one. And then another challenge is what we have seen, and this is probably the biggest for now, that by designing your system in an immutable way and using dependencies, like using existing tokens, let's say as collateral, in our case, we are using Ether. Now, Ethereum has introduced, like, well, has switched to proof of stake, so there are now multiple staked ETH tokens, derivatives that give you this yield on top. Now, of course, by not being able to offer a service against, like a loan against staked ETH, your system might become a bit less attractive. Like here, what can we do when you design a system like this? I mean, of course, you should try to reduce the number of dependencies as far as you can. Maybe avoid oracles. It's difficult, but there are systems that don't need an on-chain or an off-chain oracle. Make it easy to integrate, standardize everything, your interfaces, so that others can easily interact with your system. And last but not least, that's also important. I mentioned this potential migration and wind down. So make it so that whenever there is a need for a new version, people can easily, gracefully migrate from the old system to the new one, or even the two can coexist. That's maybe even better. Then people can choose where they want to keep their funds. But now I also want to show a few kind of a middle ground. Like there is not just like this black and white, like no governance or full governance. There is also like a path in between. Like you can minimize governance by just limit the scope, by making it so that the decisions cannot really affect or do too much harm. If it only affects the fees, for example, or some additional incentives, then maybe even if the governance goes rogue, it is not like the end of the world. Another way of doing it, even more like systematically, is by siloing, compartmentalizing the risk. If you have a lending system or some system like AMM that has multiple pools with their configurations, you can make it so that like a bad configuration of one pool cannot spill over and affect the others. Like the risk is then contained in one specific area of the system. Another one is using time locks and avoiding retroaction or retroactivity. So at least when the whole system is upgradable, make it so that it only affects new users. Or at least the existing users should have some time to just leave before the new law or new rules enter into force, so they can quit. I mean, that's already a mitigation, I guess, and for many risks. And then what you can also do when it comes to kind of the numbers, like the parameters, like collateralization ratios, liquidation thresholds, whatever, you can make it so that people can vote on them, but only between ranges. And you can, or between thresholds, and you can maybe determine the thresholds in advance through exhaustive modeling, and then you see, oh, this is the maximum the system probably is able to tolerate, this is the minimum, so let people, like, let it be, like, make it so that people can choose a value in between. And then another interesting concept is decaying governance. You can maybe think of a system that you're not so sure about initially how it would behave in practice. So you want to have governance, you want to have at least some parameters that can be upgraded, but you're confident that eventually you can find the right parameterization and then freeze it. So it means that maybe you have a first year where people can, or somebody can upgrade it, and then it is set in stone for the future once it's battle tested. And last but not least, there is also another form of governance, which is more subtle. It's not just about voting yes and no on different proposals, but it's more like wisdom of the crowd. It's less about politics. It's more about taking some median, taking some average of many different values that people can just cast their own votes. They just choose what they want to have, and then the system kind of tries to find the optimal parameterization. But even that has its limits and challenges. We have seen it now, for example, in curve finance, where you have vote bribing on an institutionalized level, and you can try to then combat vote bribing by using some fancy cryptography, but that comes at the cost of inefficiencies. So it's not easy to get this right. Now, what about Liquity? Applying all this to Liquity, I mean, it's an interest-free borrowing system that is really set in stone. Nobody can change it. Everything is just running on its own. It's one of the few protocols within this 3.5% that I've shown on the pie chart that is really immutable. And it has been doing quite well. I mean, when you look at how resilient it was for the last 2 years, it has already managed handled several crashes, including FTX and Terra Luna collapse and so on. The peg of the stablecoin that it is issuing as a loan has not been perfect, but still, I think, reasonably stable. At least it has never really depreciated below $1, or at least it always bounced back very quickly. It has seen quite some usage with more than 4 billion in loans that have been issued over time in those 2 years. While the Fed rates have gone from 0 to 5%, the interest rate on Liquity has just stayed 0. And community was a bit of a challenge, or we were a bit afraid that by putting out a system that's just set in stone, nobody would really, it's just boring. People wouldn't really care about it the same way as they care about governing and DAOs and systems that can change. But it was less of an issue. So it seems that we have other areas where people can interact, like the front ends, for example, because they are also not run by us, but they're run by third parties. So there is some interaction there. But there have been areas which haven't worked as great as the other ones. Like we are confined, tied to Ether as our sole collateral asset. Now that staked has become more widespread, this is a bit of an issue when it comes to opportunity costs. Liquidity for our own stablecoin is not great. It's very hard and costly to keep liquidity on the DEXs high because it's very costly, and we have lost out this a bit. We haven't been able to kind of successfully grow liquidity in a sustainable way, which is not easy, and especially for us because we cannot change anything now. The incentives could be optimized for the front ends and some other actors, and also, as I mentioned, the Oracle is probably the single biggest dependency that if it fails, it can fall back to a second Oracle because we have a main one and a second one. If both fail, then the whole system is done. So that's probably the biggest challenge. And yeah, there are hard problems yet to be solved. So designing an Oracle that is both decentralized and secure, I mean, we haven't seen that yet. So I think the problem with the decentralized approaches is that when you want to design an Oracle that should secure billions of funds, but the governance of your own Oracle, the value that is tied up when you want to vote is much less. It's maybe just 100 millions. Now, how can 100 millions of funds secure 5 billion? That there is a mismatch. Of course, you can just do it in a more centralized way, but then you have all the other issues. And then also the whole liquid staking on Ether. Ethereum is not really decentralized either, so that's another aspect which can be improved. And last but not least, there is also the problem that when you want to build a system that can handle funds, that can buy and sell, trade some tokens on DEXs, then you have this MEV problem, at least when you make it permissionless. Like when you give everybody the right to make a trade, to kind of trigger something that your protocol should do with funds on a DEX, you're subject to front running, you're subject to MEV attacks. So yeah, that's it. That's basically what we have been trying to achieve with Liquity. And now if you have questions, I'm happy to take them.
Thank you. Thank you, Robert, for the overview of your protocol. Are there questions right now about it? There's one question here at the front. Just wait for the micro. It's coming.
Yeah, so you mentioned that, one key aspect that you made, which also drove your decision to actually go fully immutable, right? Is, I would say, the assumption that if there is no governance, there is no liability, right? And that kind of ties back to a talk that we had earlier, where the question was, who is actually liable for what's happening, right? And I guess from, let's say, the DeFi and DeFi, developer perspective, that's a key question, right? Am I really safe deploying an immutable protocol? Am I shielded from liability? So I guess I'm just interested from your experience and thought process there. And maybe the other discussion is for the next coffee break, how everyone else sees that.
That's a great question. I've already kind of thought about it a few times. So the problem I see is that the current regulation focuses on a going thing, like on an activity that you can continue doing. And then if you do it not in the right way, they can stop you from doing it. But when you deploy an immutable system, it's a one-time act. It's done. You cannot take it back. You have just released or opened the box of Pandora. But I guess if we want to regulate this, you can do it, but then what it probably should look like is what are the best principles, what are the guidelines for you as a protocol developer? Like how many audits, how many stress testing, whatever you need to, and how do you need to document your system so that you can deploy it and be safe from liability? Even then, things can happen, things can break. You can never be 100% sure, but maybe if we have a regulation where you can be sure that if you have done all the reasonable efforts needed to design a secure system and you've released it into the wild, now shit happens, you're not liable for it because you have taken all the necessary steps to avoid. But like being subject to like a continuous like finance market regulation for an act that is a one-time thing doesn't seem to make sense to me.
There's another question there.
How do you think about the creating the demand side for LUSD? So creating sort of organic demand to use it as a medium of exchange, say, I don't know, to purchase NFTs or for remittances, to kind of, create the activity that could presumably then help you generate more liquid pools.
Yeah, that's an ongoing challenge and ongoing task of our team that we are kind of looking to engage with partners, like with all those outlets and facilities that may use LUSD in one way or another. I mean, there are use cases where you can basically refill your credit card or get like a crypto-backed credit card where you can send LUSD and it's like held in a non-custodial wallet, which is, I think, quite cool. So that's one thing. But of course, also creating liquidity on the DEXs to make the token easily exchangeable and tradable with other more established stablecoins like USDC is a way to facilitate adoption. Because currently, I mean, that's a big kind of challenge, is that there is no easy way to turn LUSD into cash. There is only one centralized exchange that is offering an off-ramp, but it's very hard to get like a token like LUSD listed on a big exchange, because they have their own stablecoins. Also, I think from an economic perspective or business perspective, they are not very keen on listing a competitor stablecoin.
Okay, one more question.
Oh.
It's not so much a question, but a comment that I think both adoption and liquidity highly depends on how close LUSD price is to the peg to 1.0. Right now, it's very volatile. Like, it's let's say 1 or 2% above 1.0, and you actually never know if it's going to be higher or lower in future when, let's say, you need to return the LUSD loan, or when you need to pay it for something. So it's there is a risk from this volatility, and this really limits the adoption, I think. So it's even probably not so much the adoption by centralized exchanges. I think it's really this. So if you manage to somehow make a smart contract which keeps it closer to the peg, or maybe some other ways, I think you do already move in that direction, that I think will help a lot with both adoption and liquidity.
I agree. I mean, that is also an issue. It's less a governance question. It's more an economic design problem, which stems from the fact that we are not cheating, or we are not taking centralized assets as collateral to just mint more. So the only way to mint the LUSD is by loans, and then the demand for loans may fluctuate, or not like be in a lockstep with the demand for the stablecoin itself. So that is a trade-off, and we are looking into ways how we can improve it, but that's like a longer ongoing research question.
Okay, I think with that, it's a good point to stop here. Thank you for having presented.
Thank you very much.
Your case. Thank you.